I am what you would call a serial bootstrap entrepreneur. Maybe it's my Indian heritage coupled with my hangover from my parents' immigrant mentality, or it's my raging imposter syndrome that routinely pops up to kick me in the butt. The idea of venture capital has always low-key freaked me out. As with things like this, the more you run away from finding out the facts, the bigger and scarier the idea becomes. Due to my self-imposed responsibility of sharing with you as much as I can about the business world on this channel, I thought it was time to put on my big girl boots, do my research, and share with you my findings. In case you are in much the same headspace as I was in, I hope this video helps. Venture capital is a type of private financing that is often organized as a fund. The money for the fund comes from a pool of investors, which may include a mix of people as well as other businesses at times. The fund has managers who listen to pitches of ideas from a diverse range of entrepreneurs who are all wanting to raise capital for their businesses. They carefully choose the ones they want to put their money into. As businesses expand, they go through various phases of venture capital funding. There are typically 3 stages. The first stage is the seed round. At this stage, a venture investor lends a modest amount of funds to a young firm for its use for product development, market research, or business plan creation. Next comes the early stage. This is sometimes treated as more valuable than the seed round, since the enterprise receiving the funding needs investment to begin to ramp up operations until they have developed a marketable product or service. Finally, the late stage venture capital financing. This is reserved for more established businesses that may or may not yet be profitable, but which have shown growth and are producing income nevertheless. Venture capitalists look for potential target firms, do due diligence on them, and then make a judgment on whether or not to make an investment in them. Following an investment, the venture capitalist or the VC mentor, advise, and fulfill fiduciary board of directors obligations on behalf of the investors who have contributed money to the VC's fund. Investment firms that specialize in venture capital make bets on businesses that they believe will be successful in the future and provide those businesses with the funding they need to develop fast. It cannot be denied how important venture capital financing is. They massively impact national and international economic growth, since they open the door to innovation by investing in ideas that they feel will either establish a new market or significantly enhance an existing one. Without venture capital funding, companies such as Google, Facebook, Airbnb, Uber, Snapchat, and Flipkart would not have been able to succeed. At the time of investment, so many of these businesses had complex or not yet established income streams, meaning that they were actually operating in a state of negative cash flow. This means that they technically didn't have the money to pay their bills. The funding by VCs into these businesses at that crucial time gave them breathing room and the time to turn those negative cash flows into more considerably profitable ones that they are today. This is where the value of venture capitalists is. For the skeptics out there, I was one of them, this all sounds a bit too good to be true. I hear you. The advantages of venture capital funding are massive. Not only are you getting access to resources like money, but you're also getting access to the benefit of expert guidance in the form of the fund manager, who is tasked with coaching their investment companies to reach profitability. You must have seen Dragon's Den. It's the same thing here. Whoever invests in you takes charge of guiding you by using their experience in business and their extensive network. The thing is, this supposed fairy tale does come at a price. By accepting money from a third-party venture capital firm, there is a very real chance you may be relinquishing control of your own company. Sometimes the investment is in exchange for a company or profit share, and it naturally follows that if the investor has a sizable stake, he will want to influence the decisions and the direction the company is moving in. This is especially likely if you are now just a minority shareholder. Additionally, the whole nature of investment is that the investors find the next big business in the hopes that this would earn them many multiples of what they originally invested. For you, this means that these investors want you to accomplish something significant with their investment. This is a lot of pressure to take on, something you will have to work on day in and day out for a number of years, with the likelihood that many of your decisions will be continually scrutinized. If after hearing all of this, you are intrigued about VC funding for your business, here are 4 strategies to help you determine whether or not you are ready to begin pitching to investors. One, you want to grow your company as rapidly as possible. If you're going to become profitable as soon as possible, a round of venture financing may assist you in ramping up operations in areas such as recruiting, production, and marketing. Two, your company has the characteristics that venture capitalists want. To be profitable, you must have a viable product with shown market potential and a consistent road to profitability. Three, you're used to working under a microscope and are confident in your abilities, because venture capitalists want to see a reasonably rapid return on this substantial investment. Everything you do will be analyzed through the prism of profitability by your investors. And number four, you're prepared to deal with a great deal of rejection. When it comes to getting a yes from a venture capital firm, it may take months or years. Most likely, you will not get funding on your first few attempts. Therefore, you must be prepared to pitch again and again and again. While you may believe you are ready for a venture capital investment, it is vital that you choose the correct time to do so. If you satisfy all of the requirements I've just listed, you're on the right page. If you aren't quite there yet, keep working on growing your company so you may achieve enough traction to attract the attention of venture capitalists themselves. You may also be wondering what sort of firms you should go for. When looking for the ideal venture capital business to pitch your company to, there are a lot of aspects to consider. A successful venture capital company has a high investment to exit ratio. It indicates that they are experienced in making solid investments. The ideal venture capitalist would utilize analytics as well as hold a thorough grasp of the business to assist them in assessing which risks are worthwhile to take. Choosing the right venture capital business is vital, since it will often supply more than simply money. Top venture capital firms that you might want to start by looking at are Intel Capital, Acel, and Kleiner Perkins. Despite the growing popularity of venture capital investments, the majority of startup owners still choose to finance their ventures on their own. Saying that, if you were conceptualizing a startup that is poised to change the face of the whole industry or how people live, there is an undoubted need for venture capital. Having an experienced business partner in the form of a VC investor who is willing to take measured risks is definitely an asset to have on your team when starting out in the business world. Now that you may know a little bit more about the venture capitalist world, my question to you is, where are you in it? Until the next one, you've got this. Hi, my name's Priyanka, and I'm being held hostage until you press the subscribe button. It's down there.